Hey, everybody. Hope you're having a good day. Good February 4th today. Glad you're here for, excuse me, long options. My name is Brent Moores, and I'm joined alongside Ms. Connie Hill helping me out in the chat here. She's very familiar with what we're going through today. She's a longtime friend and colleague. So as you have questions, feel free to type those into the chat today. I want to talk about strike selection as we choose different strikes. And, you know, sometimes we give you like these on sample trading plans, what strike you should choose. The reality is it's not necessarily that clear cut. There are pros and cons to different strikes in your long option trading. So that's what I want to kind of go through today. You can follow myself or Connie on X at Brent Moores CS, at Connie Hill CS. So we put a little extra content out there in X land for you. Options do carry a high level of risk and are not suitable for all investors. Information today is for general informational purposes only. It's not a recommendation or of any security strategy or chart type. Let's see, Paper Money, the software Paper Money application, which we're going to be showing today, is for educational purposes only. I may not include commissions in the trade examples we're talking about, but keep in mind commissions are a factor that you should consider. All investing involves risk, including risk of loss. And in the case of a long option, you're risking the whole shebang there when you trade. Even if you put on a stop loss, no guarantee that stop loss is going to trigger where you want it to, right? So past performance of any security or strategy does not guarantee future results or success. I see some familiar names over in the chat. Glad you're here. And those of you who are newer, we're glad you're here too. And those of you watching on a recording, that's great too. We're glad to have you any way you watch. This is the S&P 500. Obviously, well, look, we're up a little bit today. A lot of it's been kind of bouncing up or down on the news. It's like on the tariff front seems to be moving the markets, and it seems to change every few hours. But anyway, right now we have a trend that's generally, well, we have a bounce in the market, and we have a trend that's generally been going up. This is the S&P 500. That's a 6-month graph, but I can go back. Here's a year graph. Yeah, it's hard to, I think, deny that the trend has been going up, and I'm not seeing sufficient weakness at this point to say, I think that's changing here. So this is the 6-month graph. We're just above our moving averages. So as you look at your trade possibilities, okay, say S&P 100 or wherever you look, remember we're looking for liquid options in this webcast, and all our options webcasts that I teach, we're looking for liquid options. So that's why I'm using a list such as the S&P 100 to narrow it down. But as you go through this, you're going to find most of those stocks there are kind of trending up, right? So I'm going to probably, more of my examples will skew more bullish for what we have here today. And so, there we go. But what I want to start, I'm going to look at just a stock here to start us off. And we still have earnings season. A lot of these companies have earnings. And so I've tried to avoid companies that have earnings in the near term. But as I look for a bullish trade, and I'm going to say, we're now in an upward trend. We had a low, we had a higher low, kind of establishing a higher low. We have some higher highs. Looks like that trend is going up on Johnson & Johnson. And let's say, for example, we were looking for a bullish trade. Often we look for the trend. We just talked about the trend. We look at things like support and resistance. I can consider this kind of maybe a support bounce here. Where do we find a target price on that? Well, if we kind of consider this to be a flag pattern, one thing I can do is I can kind of measure the latest move from low up to high, and I can take that. Let me just move that. And I'm going to put that to our most recent low right there and say, hey, look, I've got a target around 162.5 on that. Okay, I'm just going to jot that down so I don't forget. 162.5 target. And I'm going to put a stop loss. I'm going to put a conditional exit maybe below where our recent bounce was. So I'm going to go to the low here, which was right there, which was 151. And I'm going to go 1% below that. So I'm going to take 151, multiply that 0.99 by 0.99, and I come up with 149.49 stop. Okay. Or as I said, because I'm doing an option, it won't be a direct stop. It'll actually just be a conditional order to exit if the stock gets down there. So what we can kind of consider here on as we do this is, if we're looking at a bullish trade, consider the distance between where our entry point is, which is right here, and our target price, which is right here, and then our stop, which is right, what did we say, 149.5, we'll say is right here. And generally we want a bigger distance between where we're currently at and where our target is versus where we're at and where we're hoping to get out on a stop if things go against us. So that's kind of going to be the basis of what we're looking at here. But what I want to do today is I want to look at this, and I'm looking at Johnson & Johnson, and I'm going to pick an expiration here. Now, expiration on these, I'm expecting it. How long did the last move up? Well, this last move up took maybe a couple weeks, something like that. So I'm going to look at a couple weeks plus some time here. 17 days may be cutting it a little close. Let's go to 31 days here and just look at these options here, because we have these choices on the options that we choose. And so what I want to do here is I want to consider, let's say we go out of the money and compare the 150 to at the money. Let's see, where's our stock? Our stock's at 154 right now. We kind of don't have anything exactly. Let me just tweak this a little bit. For our purposes right here, I'm going to, no, I think maybe we'll stick with what we have. I just want to see if I have more appropriate strike prices that are going to give me kind of right at the money. 155, those are going to be the same strikes, I think. So we'll stick with what we have here. I'm going to go with at the money, and we're at 154. We're closer to this 155, so we're going to call that at the money. We'll look at in the money, maybe a couple strikes, and a couple strikes out of the money, and look at the difference in what our what profit or potential loss we have on that. Okay, so let's do this. I'm going to look at the 150 strike. So I'm going to go in the money here, by the way, and I'm going to use our Theo Price tool. If you're not familiar with that, you can go above your option chain and just select, it says Theo Price Mark. And if you've used this before, you may need to clear it out. You just click on it and click on reset, because your old settings in there will still be applicable there. So we're going to look at the 155 strike. We're going to look at the I'm going to make this a delta here for a sec. Actually, I'm going to add, let me do this. I'm going to customize this column just a little bit. And I'm going to add a delta here because I want to see delta while we're at it. So let's add delta to that. We have that. Click on OK. Now we've got delta showing as well. So our 155 strike, we're going to go to a 150 strike. And we're going to go to a 160 strike. 160 strike. So let's compare these. We'll start with the 150 strike. The current mark value on this, and this will bounce around as we look at this. So I'm just going to write it down, and it may change a little bit on us, is 495. For the 155, the current price is 194. For the 160 strike, the current price is 43 cents. Okay, so what I'm going to do here is I'm going to kind of write this out for us. And I'm going to say the current price for our in-the-money contract is 4.95. My current price for my at-the-money contract is 1.94. My current price for my out-of-the-money contract is 0.43. All right. Now, what's going to happen if the stock, first we'll look, what if it cooperates and it goes up? And I'm just going to say it goes up, just for our purposes, up 5%. Okay, I don't want to just go what my stop is and what my target is, because that's going to be unequal. I want to go up 5% and down 5%. So I'm going to say a 5% move up, and I'm going to say it takes a couple weeks worth of time. Today's the 4th, we'll go to the 18th. And now we're going to look at this column, which is the Theo price column. It's going to tell me what this option could potentially be worth in a couple weeks if the stock goes up 5%. What's going to happen to that option? Well, the 150 strike, our in the money strike, the theoretical price is 11.48. So I'm going to write in 11.48 here. Okay, there's my Theo price, 11.48. My at the money contract, or close to at the money is what we're going to call it, goes up to 666. 666. So let me do this. 6.66. And my out of the money contract, which is going to be at the 160 strike, is 268 is our new Theo price, 268. So let's write that down and just do a little math here, 2.68. So how much money, what's our dollar change in the option with a 5% move in the stock? Well, if I take 11.48, subtract 4.95, I come up with 653. 6.53. Okay, that's the dollar change. And we'll kind of summarize these results here in just a minute. If I go from 0.66 minus 1.94, that is a 472. So which are we going to make the most money on dollar-wise? Well, 2.68 minus 0.43, 225. 2.25. The one we're going to make the most money dollar-wise is the in-the-money contract. Okay, and let's kind of generalize that and say, I don't care whether you're doing a long call or a long put. Obviously, we're looking at calls in this case. Long call or long put. If you buy the in-the-money contract, you're more likely to make more money dollar-wise from a dollar perspective, the more in the money you go. Okay. And Andy says, is a 5% change reasonable? Well, that's a good question. I'm trying to think about this in terms of what is reasonable, right? In this case, we were talking about the stock going from about 153 up to about 162. What's the math on that? 153, actually, 162 minus 153 is $9 divided by 153 is our starting price. That's about 6%. That's about a 6% move. So I think my point is not necessarily for this particular trade, but in general, when we're looking at these type of moves, I would say 5% is a pretty reasonable move. Now, let's say we did a 10% move. I'm not going to do it right now, just for time's sake. But if we said a 10% move, you know what? You would see the exact same thing. The dollar change would be more for your in the money versus your at the money, and more for your at the money versus your out of the money. Okay, now let's consider this from a percentage change standpoint. So entry price, so I'm just going to take my Theo price, okay, and I'm going to go, and that is about 230% return. 230%. Actually, I guess let me think of that's 230% of this value. So let me do it this way. 1148, I think this is technically the way you should do it, minus 4.95 gives me 653. If I take 6.53 and divide that by divide that by 4.95, I get, we'll say 132% there, okay? 132% return, 132%, okay? So another question from Ahmad, is a 32-day expiration reasonable for a call option? Absolutely. Over the past several weeks in this class, I have gone through different types of trades on here. We've talked about swing trades, which are shorter term trades. We've talked about trend trades, which are longer, more intermediate term trades. We've even talked about leaps trades, which are very long term trades. We're not planning on holding it the whole time. Here we're only going 2 weeks, but very often we'll go out about a month on these contracts here. Okay, so good question, Ahmad. Thank you very much for that question. So that's our percentage return on that. Now I'm going to do the same thing here. I'm going to go 6.66 minus 1.94 well, actually, I don't need to do the math. I already have it written down for me. Divided by 1.94, I come up with about 243% return, okay? 243% return. Now, something I need to mention is right now I'm going through the good scenario. That is, the stock goes up 5%. We will go through the bad scenarios too, because obviously risk is just as important a factor as the return, if potential return, if not even more of a factor. 2.25 divided by our initial starting price by 0.43 gives me a 523% return here, 523%. Okay, so we already mentioned, everybody, that the more in the money contracts from a dollar perspective are going to change more if that stock goes up. We'll make more on that. But from a percentage standpoint, that's not the case. If I were to generalize that, I would say, in general, if you go out of the money and you get a pretty good move, then your actually percentage return, because your initial investment is pretty cheap, right? And I'm not factoring in commissions here, but is your percentage return is going to be bigger. Okay? So that's why we call this a more of a leveraged investment there on that. Okay, now let's move forward. What I want to do here is I'm going to do the same thing. I may go through a little quicker here. What if the stock doesn't go anywhere? Now remember, these long options, we're talking about long options here, have a time decay that is working against us, okay? So theta is negative on these. What's our Theo price though if the stock goes nowhere over the next 2 weeks here? Okay, so what I'm going to do here is I'm going to go back to our trade tab and I'm going to go to my Theo price. I'm going to leave this at 5%. No, I'm not. I'm going to make that 0%. I'm going to leave it at 2 weeks out. Click my enter key. And now let's see what happens to it. What happens to that $150 contract? Well, the $150 contract goes down to Theo price 437. 437. Theo price. So we've lost money. 437 on that. We're going to lose money on all these because time decay is going to affect all of these. What about for the 155 contract? It goes down to 124. Okay. Again, we've lost money, 1.24. And for our out of the money contract, which is going to be the 160 contract, it goes down to 18 cents. Okay? 18 cents. So let's do another little generalization on this. 0.18. So what's my dollar value change on this for my in the money contract? I'm going from 4.95 down to 4.37. I come up with a 58 cent 0.58 cent loss. Okay. At the money contract, I go from 1.94 to 1.2. That's easy math. That's a 70 cent loss, 0.70 loss. And for my out of the money contract, I go from 0.43 to 0.18. That's about a 25 cent loss. Little less clear cut on that, but what I would say is this. Time decay affects your at the money contract typically the most, okay, in terms of the rate of time decay. In terms of the rate of time decay. Now, obviously, if you held this all the way to expiration, that out of the money contract would be worth nothing at that point because that's all extrinsic value. There's that. So what about percentage change here on this? So what's our percentage change? Well, my percentage change 0.58 divided by 4.95 is about around 12% loss. Okay, about a 12% loss. Oops, that was supposed to be a 12. And that's a 12% loss. I don't know if I need to put a percentage in there, but we'll do that. Percent loss. Come on. Okay, what about at the money contracts? 0.7 divided by 1.94, I come up with about a 36% loss. 0.36% loss. And finally, out of the money contracts, I've got 0.18 divided by, 0.25 divided by 0.43. I come up with about a 58% loss here. So there is something that's consistent between these. The leverage factor that we talked about earlier, about what's the most leveraged contract, that holds true here. Out of the money contracts are almost always going to be the most leveraged contracts if you're choosing. I don't care whether we're talking about swing trade, a trend trade, or a leaps option. Out of the money contracts are going to be the most leveraged contracts that we look at typically. All right. Okay, let's do one more scenario here, and then let's play some trades. Well, one more scenario, then I want to make some general assumptions about when we should go in the money, at the money, out of the money, or the pros and cons on those. But then I want to then we'll play some trades. Okay. And let me just, these are all the same, so I'm going to go 0.43 on that. Okay, let's look at our Theo price here, but we got to change this because we're going to say our stock price is going down 5%. You can model downward moves with this Theo price tool. You just put a negative sign in front of it. Okay, then you click your enter key, and let's see how we go. So at the money contract, or excuse me, in the money contract, we were looking at the 150, excuse me, the 150 contract. We go down to 44 cents on the Theo price. 44 cents. This is a 5% move. 0.44. At the money contract, that's the 155 contract, about roughly 3 cents. Is practically down to nothing here. Okay, so we'll say 0.03, 0.03, and the out of the money contract is going to be essentially nothing. Okay, where are we? So nothing. So we've lost it all on that out of the money contract. Okay. So dollar change, it's going to be, again, I think we're going to see that leverage component here, but dollar-wise, what are we going to lose the most money on? If I go 4.95 minus 0.44, I come up with a $4.51 loss. Here, we're going to get a 191 loss. Here, we're going to get a 43-cent loss. Percentage-wise, so actually dollar-wise, what are we going to lose the most on? In the money contract. Percentage-wise, 451 divided by 4.95, I come up with a 91% loss. Okay, 91%. Here, it's going to be essentially a 99% loss. And finally, out of the money contract, it's going to be 100% loss. Okay. So, again, leverage components. This is dollar-wise, we're losing a lot more here. So one kind of nice thing on that out of the money contract is, even though this is the most leveraged, and by a percentage measure, we are losing the most, from a dollar value, we're actually limiting our losses quite a bit here on this. Okay. So all told, what I would, and generally we're not planning on this, and one reason we're putting in stop losses is to try and prevent these massive losses. But in general, if I were to kind of generalize this, what I'd say is you're going to get the biggest price movement when you go in the money on these. That's going to show you the biggest price movement. In a sense, you're getting, and that may, because our delta is the highest on that, right? In the sense, it's getting closer to being more like the movement of the stock. Now, options aren't stocks. Options have expiration dates. Options have time value. But in terms of the move from in comparison to the stock price, you're getting the closest thing by going in the money on these, whether you're going, whether it's up or down. Secondly, the most leverage, you're getting the most leverage going out of the money on those contracts. So if you want to be more aggressive on these, within reason, you may shift more towards out of the money contracts or at the money contracts. If you want to take maybe something, a less leveraged approach, go to those in the money contracts there on that. Okay, so that's how that works. Practically, when we are trading, say, leaps, we often go more in the money on leaps, or trend trades. We're more likely to go in the money. We're trying to be a little less speculative on those trades. A lot of times on these shorter term swing trades, we're willing to go closer to at the money. Usually we don't go very far out of the money because it necessitates a bigger move there. Because remember, if we start a long ways out of the money and time passes and we never get in the money, the odds are just working against us in that standpoint. So more conservative in the money, generally longer term, we're going in the money. more aggressive, we're looking more towards the out of the money, at the money, or if we really want to be aggressive, a little bit out of the money on those is how we do that. Okay. There we go. So let's look at some trades here. So George says probably the touching is approximately the delta times 2. Yes, that is correct. The probability of delta is probability of touching is going to be about the probability in the money times 2. And you can do that. Just bring up a probability in the money or delta, which we sometimes use as kind of an approximation for that, and your probability touching, and just put the columns side by side, and you'll see that. Let's look at the actual trade here, though. All right, now that we've kind of generalized that, I wrote it down earlier. We have our target price, we have our stop price. How aggressive do we want to be? If I want to be more aggressive, which I'm going to say, I want to be more aggressive in this from this standpoint, I'm going to go to the at the money contract. Well, at the money, we don't have anything exactly at 153.5, and it's moved a little bit on us. Maybe we go, let's go a little bit more aggressive on this. This is about as far out of the money as I'll typically go. We're going to a lower delta there. I'm going to right click on this. I'm going to buy custom. We're buying a call option here with OCO bracket. That means I have my entry right here. I have a target price. That's my limit order. Let me just move this column over and see if we can see that a little bit better. I have my target price and I have my stop price. Now, these are based on the option price. I can do that. I've done that in the past, but today, in fact, I'll show you one that we have a stop on, I think, based on the option price, but I'm going to base these on the stock price movement, okay? So what I'm going to do is I'm going to make this a market order, and I'm going to make this one a market order too while I'm at it. These are our exit orders. I'm going to make them good till canceled. And when I click on good till cancel, it's going to give me a little error message. It's going to say market order must have a daytime in force. There's an exception to that, though, and that exception is one we're going to use. If you go to the gear and add in a conditional order, then it's okay. So I'm going to click on that gear, and I'm going to say if Johnson & Johnson, J&J, marks greater than or equal to, and our price was 162.50. 162.50. We're good. I'm going to click on save. I'm going to do the same thing here. I'm going to say if Johnson & Johnson marks less than or equal to 149.49, 149.49 or less, we're going to do this. Now, some of you may be thinking, can you do them both on the same? Can I do a less than or equal to here and a greater than or equal to here? Yes, you can. You can do it that way. And sometimes I do it that way. But in this case, I have these two lines here. This is a first triggers OCO order. What that means is if this order fills, in other words, we buy that call option, I then have these two orders to sell out of the call option. But what I don't want them both to always be active. If one of those fills and we sell out of the call option, I don't want this order to stay around. I want that to cancel, and vice versa. If we go down and hit our lower price, I don't want another order to sell another option because I'm out of the option at that point if the stock goes up there. Okay? So there we go. Let me, now, current price. It's showing a limit of 181. So it's moved a little bit on me while I've been putting in this order. That's saying I'm willing to buy for 181 or less. I really should be able to get filled at that. That's the natural price right now. Can we buy it for a little cheaper? Yeah, maybe. We could maybe go to 180. Could we go down to the mid price of 178? We can try it, but it's probably not going to fill immediately if I were to do that. Okay, so let me click on confirm and send. We just sent that order. That has been filled. okay? Now, I want to go through another one, but I'm going to go a little quicker, and I'm not going to go through all the calculations I went through before. I just want to look at an example type trade here. And maybe we'll even let's do JP Morgan here. So obviously financials, the trend, that's our first technical analysis thing, is up. We had a nice little bounce here. I'm going to call that bullish. I'm going to do a similar thing on that target that I did before. Our recent low was 239.5. Our recent high was 271 or 270. So 270 minus, 270 minus 239. That was about a 31-point move from the low. I'm going to go from the low. That would give us a target up in the 292 range. So it's a little bit off my screen there, right up there, about 292. That's where the target. Now, that doesn't mean it's going to, this potentially could take a little while to get there. This one took a good 3 weeks, I think, to get up there. And so I'm going to maybe give myself a little bit more time here on this. So there we go. So we said 292 target. I'm going to do a stop. I'm going to go 1% below my recent support level. Question from Andy. Am I going to adjust that stop up daily? Probably not daily, because what I'm going to say is here, I'm going to put my stop in below our recent, I'm going to consider this to be a support level where we bounced. That's not going to go up every day, that support level. But over time, we will move it up as we reach new support levels along the way. If it bounces on the way up, or if it moves up enough, we may want to consider protecting ourselves. And I'm going to try and get to an example here where we do that. But I'm going to go 1% below my low, which was 261. 260. Actually, where were we at here? Our low on that day is 261.77 times 0.99 gives me 259.08 stop. Okay. I'm going to right click on this. I'm going to buy, no, I'm not. I'm going to go to I got to select my option. On this one, we said we're going to go out a little more time here. So I'm going to go out all 45 days here on this to give us a little bit more time for that at work. Remember, we have the choice. Do we want more leveraged or maybe a little bit less leveraged? It's going to be a little more expensive if we go in the money. So I'm going to go in the money just a little bit on this. So instead of the 265, which is, I'm going to go up to 6, we'll go up here. It's going to cost us $12.80 on that. I'm going to right click on this. I'm going to buy custom. And I'm just going to do with stop here, just to kind of illustrate the other way to do this. Here, I'm going to make this a market order. I'm going to make it good till canceled. I'm going to go to that gear. But now, look, I can do both conditions right here. I can say marks less than or equal to 259.08, 259.08. Just, it's blank. You don't see a line there even when you look at it. But if you put your cursor there, it's like if you build it, they will come. You put your cursor right there. It will show, it will appear. Mark greater than or equal to, we said 292. Okay, 292. Save that. When I do indeed click on confirm and send on this, notice it's going to give me, it's going to tell me about this. JP Morgan marks at or below 259.08 or above 292 even. Okay. Make sure you read these screens. Okay. Make sure you read those screens there on that. And I didn't do this with the other one, but I should have. Let me click to long single options and send that. Okay, now here's what I want to do. I have those orders in, but I want to mention, because somebody mentioned stops earlier. Here's American Express. We have a long call option on American Express. We've been in this for, a couple weeks now. And it's doing well, it seems. This is a trend trade, AXP, okay? You can see the trend has been going up, and the stock right now is about 316. We can look here and see where is our exit on this. American Express, weight condition. All right, we have about a 309. We're looking to get out at 309. If we've moved up enough on that, then which is right, 309 is about right here where my cursor is. Can you see that? Right about there. That doesn't seem unreasonable to me. So I'm not going to move that stop up. The trend's not breaking, so I'm going to continue. I'm just going to stick with this trade for our example purposes. Let's look at BIIB. We are losing money on BIIB. It's a long put. We've only got 17 days to go to expiration. Let's just take a look at the chart on this. Here's BIIB. The general trend has been going down. This is more of a swing trade though. I have earnings coming up. It's kind of, from when we got in, we went against us, it's gone better. We're still losing money, but we're at the point where we have earnings coming up and we don't have that much time left in the trade. And so therefore, I'm going to consider, in fact, I'm just going to get out of this trade here, okay? I'm just going to get out of this trade. We do have an order to get out of BIIB already. Let's see what that is. Come on, there we go. If it goes above 151.50 or below 135, 150 is way up here, so that's a long ways away. We could move that stop down or below 135. That would be our target price. Well, we're still a ways from that. There's two approaches we could take on this. I think I'm just going to get out of this. But another approach, to someone else's point, to Andy's point earlier about adjusting that stop, we could adjust that stop a lot tighter if we wanted to. But for our purposes here, I'm just going to get out of this trade. So therefore, what I'm going to do is I'm going to cancel this order, and I'm going to exit it. I'm going to create a closing order. We're going to sell that and confirm and send that order. Okay, we're out of BIIB. One last, and then I have to wrap up. This is the one we just did, but here's Visa. Visa, we have a call. This is a LEAPS call, 499 days to expiration. So obviously there's no urgency there. It's doing well. As long as the trend is going well on this, we probably want to stick with this. It's doing very well. Hard to argue with that. Could we adjust the stop? The answer is yes. This is actually a traditional stop based on the option price. It's a 36.50 stop, which was basically 70% of our trade price. Well, our mark has gone up to 67 now. To keep that 70% stop, if I take 67 multiplied by 0.7, I come up with about $46 stop. That I'm going to adjust that stop up. I'm simply going to right click on it, cancel and replace that order. I'm going to make this $46 on my stop, actually 46.9 technically, and confirm and send, and we've just adjusted that stop up to try and capture our profits there. Okay? All right, everybody. We talked about how in the money or out of the money affects your option prices. We did a couple trades trying to hopefully kind of illustrate those principles. And we also talked about kind of stops and adjusting stops there. So there we go, everybody. Hey, everybody have a wonderful rest of the day. And let's see, the trend column question from Sandeep, that's a standard column, folks. That's a standard column. That's nothing unusual there. It's not a shared script. Everybody have a wonderful rest of the day. Coming up next, we've got Getting Started with Technical Analysis. And we'll talk to you later. Bye-bye, everybody.